So I think it would be an understatement to say we live in strange economic times right now. If you look across the globe, most economies are still closed. Unemployment levels are at all-time highs. Governments are printing trillions of dollars just to fund these stimulus programs that we're going to have to pay for in the future, by the way. Yet for some reason, major stock markets are really trading only 13 to 15% below previous all-time highs. How does that make any sense? So I wanted to dive into this a little bit more. I have not made a video in about a month now, which is why I set up this little home studio here, because there's too much going on to not discuss it. We're seeing a lot of volatility out in the market there, and I think one of the most common questions I'm getting from people now is this just kind of, what they often call a bull trap, where you see a little hint at a bull market and people think that we're on the road to recovery, things are looking good, they buy in, and then we all get screwed. So the question is that what's happening here? If I were to make just a complete guess as my own, humble opinion, this doesn't feel like a sustainable recovery because none of it's being driven off fundamentals. It's being driven off massive, massive, massive stimulus programs, optimism around a vaccine being essentially around the corner. It's definitely not the fundamentals of the businesses. Corporate earnings are not going to look good. Dividends are going to be cut. Now, in this very strange, very uncertain, very sketchy time, how is it that it could be trading at almost the same valuation as what it was previously when we were actually seeing record employment, earnings seemed fine, and news was quite positive? So what really caught my attention is that April, in spite of all the negative and scary news around the world, April was the best month for the Dow Jones and the S&P 500 since 1987. Now, as I mentioned, it's essentially the Federal Reserve and other monetary authorities that are propping up the market right now. Stimulus payments, that's one thing, but also lowering interest rates, buying bonds to basically lower interest rates further. They're trying so hard to juice money into the economy to get people, a little bit more confident. Interest rates. Well, what happens is when interest rates are cheap, people borrow money. They finance cars, they take on mortgages, they take on corporate loans for your business so you can create new products, hire, market, all of that. General idea, when money's cheap, people like to spend. Now, the thing is, this just isn't nearly as effective as it used to be because interest rates are already so low and consumers and businesses already have so much debt. So the Federal Reserve just doesn't have the same firepower as they used to. So though this can have a great short-term impact, which as we've obviously seen in the market, it has, long-term, this isn't a sustainable solution. For a market to really recover, we have to see businesses recover. We have to see people back in their offices. We have to see consumers able to spend money. And that's something we're absolutely not seeing right now. Without a working vaccine in the world, life just simply can't go back to normal. A lot of these businesses, restaurants and otherwise, are going to have to increase prices just to survive. So it's not exactly a pretty picture. It's not like the economy reopens and then all of a sudden things are back to normal. This virus is so contagious. Once you open up the economy again, there's a really good chance that it could just have a second wave of outbreaks. If we experience something like that, then the economy just has to shut down again and we're right back where we started. So the fact that the stock market has run so much off of so little, with so much risk still out there, makes me nervous. Warren Buffett being obviously one of the best proxies for investing knowledge on the face of this planet, he is currently sitting on a record pile of cash. A great indicator to look at is called the Buffett indicator. And what that essentially does is it takes the valuation of the overall stock market and it compares it to GDP. It's actually predicted downturns in both 2000 and 2008. Right now, it's basically flashing danger signals. We are more likely to see another dip in prices simply because fundamentals are so bad. What if there's another outbreak of this illness? That could shut down the economy again and we're right back where we started. Now, I'd be curious to get all of your opinion. What are you guys doing? Are you looking to buy right now? Do you think we are on the road to recovery, or is now a better time to maybe have some cash? I'd love to know your opinion. Leave a comment below, and please, if you enjoyed this content, give me a like. That helps immensely for the YouTube algorithm. Thank you very much.